Good evening. It is Friday, January 19th, 2024. This is my presentation for the 2024 Metals Investor Forum. The only two metals you need. Forward-looking statements. I will be making some forward-looking statements, so please consult this disclaimer. The two metals for the 2020s, the red metal copper, the yellow metal gold. First of all, I want to say making predictions about the future is always treacherous. I firmly believe that if you want to look like a fool, get up on stage and talk about financial markets for 20 minutes. Always opportunity to look back and laugh at what we thought in the past and what ended up transpiring. I also believe that nobody knows anything in financial markets, including me. But that being said, I am going to do my best here, and I believe that copper and gold are the two metals for the 2020s, and I am very optimistic on both of these metals. Some quotes to start off the presentation. Gold is money, everything else is credit. JP Morgan. And then I love this Rumi quote, but especially the part, through love, all that is copper will be gold. And maybe over the next year or two, the price of copper will get a little bit closer to the price of gold. And Yogi Berra, it's hard to make predictions, especially about the future. It is hard to make predictions about financial markets. There is so many variables and so many things can change, as we saw in March 2020 when the world was turned upside down almost at a moment's notice. So why copper and gold? Well, copper is the metal of human progress, of infrastructure development, and the energy transition. Gold is the timeless store of value with no counterparty risk. Gold is truth in a world filled with lies and growing mistrust. It is good as gold. And investing, simpler is better. So let's focus on long-term secular trends that I believe will outperform. Both copper and gold benefit from secular tailwinds. So these are very powerful trends that aren't likely to shift anytime soon, that will continue to make them more and more valuable in the currencies that they are priced in. This is a 9-month chart of copper. Basically, as you can see, it's gone nowhere. I'm a technical analyst. I look at this and I see a big mess. There's nothing we can really draw from this other than it is range bound. Up, down, up, down, up, down, all around, and recently down about $3.95 a pound to $3.70 to $3.75 a pound in the last couple of weeks. And I think this $3.75 price is an absolutely tremendous opportunity. Why has copper been weak in recent months? Well, I think we've seen a slowing in the manufacturing side of the economy, and just looking at a whole different things, including general business conditions. I mean, take a look at where this is at. This is below the 2008 financial crisis low on this index. So while, we're talking about, the jobs market is great, the GDP growth is great, there are a lot of aspects of the economy that are not great, okay? It is not a simple picture that can be summarized in a couple of sound bites. But whether you look at the Empire State, Philly Fed Manufacturing Index, those are all extremely weak, and they've been weak for a year or more. So that is why copper has been so soft. Another aspect of the copper story is China. So as I had the Chinese flag in one of the first slides, China is a big driver of both the price of copper and the price of gold. And China is facing the fallouts from the bursting of a property bubble. deflationary pressures. We've actually gotten some data points in recent months from China that are showing deflation. So the People's Bank of China, the central bank, is likely to ramp up stimulus and potentially in a very big way later this year. The US Fed is also about to embark on a rate cutting cycle. There's a lot of controversy, all kinds of different opinions on how fast they're going to go, how deep they're going to cut. But I think there's a pretty good chance that we're going to see the Fed funds rate under 4% around this time next year. And they might even go further. I think a lot of people think that the neutral rate, sort of where they'll target, is somewhere down around 2.5 or 3%. So that's a long way away. That's 10 to 12 rate cuts to get down there. I also think that the Fed is going to very soon, the Fed will announce tapering of quantitative tightening. So they're going to slow the unwind of their balance sheet because they have to. And we're going to get into that more in a little bit. But we're basically on the verge of embarking on a period of monetary inflation. Another one. After tightening in 2022 and 2023, global central banks are about to shift back into easing mode because a third year of tightening would really break things, and inflation is really come back to target. In fact, it's looking like inflation is overshooting to the downside in certain areas. So this is an uneasy calm in copper. The world has decided to transition to from fossil fuels to renewable forms of energy, so-called green energy. To make that happen, we need a lot of nuclear energy. We need a lot of copper, okay? But very few people understand the structural constraints of this transition. They think that these metals can just come out of nowhere in abundance. And the reality is that the dominant constraint on this transition to green energy is the mining of the metals. And the mining industry is not very good at increasing production. EVs require about 400% more metals than ICE vehicles, and new mine supply continues to be underwhelming, and there's a continued reluctance to bring new mines into production. So this dynamic of a looming increase in demand amid stagnant supply has worked while copper has remained well supplied during a period of aggressive monetary policy tightening as countries are drawing down their inventories. But what will happen when the switch is flipped the other way and we go into easing and stimulus? So the real challenge is copper supply. And we were in surplus in 2023. That explains the relatively tame copper price, but now we are flipping back into deficit. And actually, this number is incorrect now based upon what we're seeing with the latest reports from the big miners, including the shuttering of Cobre Panama. So we are moving into deficit. Copper miners continue to miss production targets. Codelco, the largest producer of copper in the world, had its worst year in a quarter century. Cobre Panama shuttered. This is a huge copper mine, 1.5% of annual global copper production, 350,000 metric tons offline. That is leaving a gaping hole and putting copper into deficit. We know one thing. There's one consistent theme in mining, and that is ore grades declining. You can see the last 20 years, it has been a glacial descent from 1% average copper ore grades to 0.6%. And I actually think this is now under 0.6%. So lower ore grades means higher costs of production. And as you can see, costs are escalating significantly as the ore grades decline. Okay, it's sort of a parabolic curve. The lower you go in the grade. Robert Friedland, brilliant billionaire mining investor, he's talking in his book. He says $15,000 a ton price is needed. A stable $15,000 a ton price is needed for a long period of time. before the industry can really gear up and build those giant mines needed to meet the surge in demand. Now, this is an interesting chart. It's a very bullish one if you take it at face value. It might not be quite as bullish as it looks because China definitely has a bit of a shadow inventory. But still, this showing China destocking copper cathodes throughout 2023, really weighing on the price, and they can't really destock much further. So there's a real opportunity here right before China starts restocking and starts stimulating its economy to get into copper at $3.75 a pound. China inventories are at a record low, and copper has swung now to a deficit in 2024. So this is an updated graphic from Goldman Sachs, and you can see we are firmly in deficit, more than 500,000 metric tons deficit in copper. And by 2026, it will probably be 1 million metric tons. So very compelling supply demand dynamic in copper right here, and it's still sitting at $3.75 a pound. The bull case for gold, I believe, is also very compelling. Number one, looming monetary inflation, rate cuts from global central banks, yield curve control, and yes, the resumption of QE is coming. The yield curve control right now is more of a stealth yield curve control that's being done by the Treasury. The Treasury is refunding itself mostly with the issuance of T-bills, so the front end of the curve. So they're reducing the supply of the long-dated bonds to try to keep long end yields lower. Obviously, the Treasury sees the Fed will lower interest rates over the next year or two, and they'll be able to refund at lower interest rates. They'll be able to place longer term debt at lower yield levels in the future. Okay, so this is a yield curve control, trying to hold down long end yields. Deglobalization and declining trust globally is a very important aspect of the bull case for gold. Less trust equals deglobalization, de-dollarization, and countries onshoring its reserves. So, you're not going to be, China's not going to hold its gold in New York. Germany's not even going to hold its gold in, New York. Poland, Turkey, they're going to continue to accumulate gold via their central banks, and they're going to bring it into their own vaults. And de-dollarization is gaining momentum. More and more countries are settling trade in currencies other than the dollar. Gold is being transferred from west to east. The rise of the Shanghai exchange. Shanghai is setting the gold price now. Okay. Changing ownership of gold is best illustrated by the changing correlation of gold to U.S. real yields. And we're seeing persistent consumer demand in both China and India. These massive Asian populations, more than 2 billion people, they love their gold. Now, what happened in October 2023? So this is an important chart, and early October 2023 was a very important moment in time. This was a moment where gold got down to about 1825, 1830, and it V-bottomed, actually more than V-bottomed. What happened? What caused this trigger? Some people are going to say the Hamas attack on Israel, that's not it. Okay, that is absolutely not it. The buying started on a Friday before that attack, and I believe the Chinese central bank stepped in and was an accumulator of gold at this 1825, 1830 level. China bought a lot of gold in 2022 around the 1800 level. They were a persistent bid in the gold market around 1800, and I believe they came back in and bought it again when it got down close to their level. And that shows. I mean, we have the data that China accumulated a significant amount of gold again in October, November of this year. I also believe that the market started to get clued in on the Fed pivot in October and into November. This whole run from 1825 to over 2100 over about 2 months, a lot of that was market participants catching wind that the Fed was done and a pivot was at hand. Central bank gold buying remains strong. We know about that. The PBOC, so the Central Bank of China, accumulated more than 200 tons of gold in 2023, and they stepped up their purchases beginning around Q3 2022. So that was when this really started to go lift off, was right around middle of 2022. They started to hit the buy button in gold. The gold price bottomed just as China began its accumulation. So this is what I'm saying, that China is a very important marginal player in these metal markets. When China is buying, price is usually going up. When China is selling, like we saw copper in 2023, price is usually going down. So the real yields chart, this is a little complicated, a lot of arrows on the chart, but basically it's showing you the red real yields have gotten more positive in the last couple of years, and the gold price has largely broken its correlation to real yields. But these correlations, they shift around. They don't stay the same all the time. You can see recently it's been positively correlated. As real yields have fallen in the last couple of months, gold has risen. Annual growth in M2 money supply. So this is the tightening that we've seen since 2021. Just M2 growth absolutely crashing since 2021. The Fed realized it had caused way too much inflation, and it decided to cut off the money supply, cut off the blood flow to reel back in inflation, and they have done that. They have been successful. But now we're about to shift back into loosening. You can see tightening 2021, 2022, 2023, and now easing. And we're back into an easing trend. We're just getting back into looser financial conditions territory. Okay. So this is the beginning of the monetary inflation I'm talking about. And why is the Fed going to cut? Why is the Fed going to slow down, taper its quantitative tightening? Well, the US debt and deficit are the number one, number two, number three reasons for all of that. Expenditures are exploding higher. The red line is expenditures, absolutely exploding higher, outpacing receipts, tax receipts by a very, very wide margin. And the interest on the US debt is expected to reach 20% of total tax receipts by next year. So 20% of the money the government takes in from taxes is gone immediately, just paying interest on the debt. And that number will only get larger. That percentage will only get larger over time. The US Treasury is now paying more than $1 trillion in interest on the debt annually. $1 trillion. The tightening, the raising of rates by the Fed has also cost the Treasury significantly more money each year. So we're financing $34 trillion at 3.2%. Okay, so you do the math on that. That is more than $1 trillion in interest on the debt annually. That is a mind-bogglingly large number. Look at the red ink of the US government. I mean, it's just absolutely eye-watering. Obviously, we know 2020, COVID, more than 3 trillion, but even now, 2023, almost $2 trillion deficit, and we didn't have a pandemic. We had a pretty good stock market. We had a decent economy. And still, the deficit is more than $2 trillion. Well, 2024 is a big election year. The deficit is not going to decline during an election year. In fact, it's only likely to go up, likely to go back to $2 trillion. A lot of economists are already saying that we're heading towards another increase in the annual deficit. So the debt is ballooning, the interest on the debt is exploding, soaring. And one of the bear cases, for gold is that the soft landing talk, that the economy is really going to have a soft landing. But there's so many data points that are showing persistent weakness that it's just hard to buy it fully. Yeah, I know that the jobs data supposedly is really good, but I keep hearing more and more companies laying off more and more employees. I don't necessarily see it showing up in the numbers, um, but there's a lot of data points out there that are showing an economy that is as bad as 2008 global financial crisis, and the Empire State Manufacturing industry is one of them. The payroll revision, so the monthly payrolls come out, and basically every single month for the last year, they've been revised lower in subsequent months, totaling 500,000 revisions down, minus 500,000. So tell me that is a real number that comes out there every month. If it is being consistently revised down in subsequent months, every single time, I believe that maybe there's some games being played here where they want the numbers to look good when they're reported so they can tout the strong economy. And then the revisions come in sort of, quietly. Only a few people pay attention to them. And meanwhile, the administration's talking about the headline data and how good it is. But the revisions, look at this, look at the trend. So look at times in the past when the payroll data was being revised lower by this margin. Every single time it was a weak economy, okay? The only one it wasn't was in the mid 80s, okay? So I believe just that the debt situation is out of control and the Fed is forced to pivot. The BTFP, so the little bank, uh, lending thing they did last March, when we had the regional banking crisis, that's expiring this March. Expect them to extend it another year, and also expect the Fed to announce it's tapering its quantitative tightening. So it's going to slow its balance sheet unwind and begin to cutting rates. So you have the prospect of falling real rates, falling dollar, and deficit debt that's completely out of hand. This chart shows the deficit overlaid with the gold price, and obviously the trends match up pretty well. The numbers aren't perfectly aligned here, but basically the trend is heading for $5,000 an ounce gold. I don't know, a few years from now. So too much treasury issuance, just too much issuance. They're going to announce QT. They'll probably announce it in March. It will start in April. And so they'll just be unwinding fewer treasuries than they were previously. Okay, so there's going to be less supply of treasuries than previously forecast. Basically 420 billion less than previously. Sorry, 300 billion less than previously forecast. And what happens to gold when the Fed stops hiking rates? Here's early 2000s, gold up 43%. Here's late 2000s, gold up 76%. And here's just recently 2019, 2020, gold up 54%. Okay. And so the trend is your friend, as they say. Fed stops hiking rates, starts cutting, starts easing. Good for gold. And perhaps the biggest case for owning gold is just nobody owns it. 0% of professional money managers have a greater than 10% portfolio allocation to gold. I did a poll of my followers on X. 2 out of 5 respondents own zero gold. That's pretty shocking considering who I am and who my followers might be. And according to the data from the World Gold Council in 2021, those aged 25 to 35 years accounted for 75% of consumers in gold shops in China. The Chinese love gold, even the young Chinese. After 18 months of investor selling of gold via ETFs, the switch is about to be flipped to net buying of ETFs in the US. At least that's what I think is about to happen as the Fed starts cutting. And this is a monthly chart of gold cup and handle pattern. You can see this big cup formed here. This is a little handle over here. This is extremely bullish long-term pattern. It's very well constructed. The cup, basically almost a 10-year cup formed here in gold. And the handle, well, I mean, the handle's about 3.5 years old. I think that we're getting right to the sweet spot here where this will decisively break out in 2024, hold its breakout above 2100 at some point later in the year. And this pattern, depending upon which technician you talk to, targets somewhere between $2,700 and $3,000 an ounce a few years from now. So that would be absolutely fantastic if you're a gold owner. Conclusion. So copper stands to benefit from a confluence of factors. But I think the biggest one really is the supply side of the equation in copper is so incredibly challenged. And stimulus, monetary inflation will be bullish for both metals, both gold and copper. I think we're at the sweet spot of the cycle for gold. The Fed pivot to easing after the most aggressive tightening of our lifetimes. Central banks continue to accumulate. So why fight the Fed? Why fight the central banks? And the gold price setting is shifting from west to east in an increasingly unstable world, debt-ridden world. I want to be long of the metals that civilization has been built upon. And now, 3 copper gold junior stock ideas. American Eagle Gold. They're here on my panel today. Hercules Silver and Western Exploration. So American Eagle Gold is 100% focused on its NAC project located near Smithers, BC. Company recently announced a hole 302 meters grading 1.09% copper equivalent. This project has some big, juicy intercepts, including 900 meters of 0.5% copper equivalent. So this is a large scale copper gold deposit with some near surface higher grade zones. Great location, great access, and mining major Teck has taken a 19.9% stake in American Eagle. Hercules Silver, new discovery, really the toast of the town in the junior mining sector in Q4. Hole grading 0.84% copper over 185 meters. Was sexy enough that mining super major Barrick Gold took a 15% stake in Hercules, including investing $23.2 million at $1.10 per share. And then Western Exploration, high grade gold in the best mining state on the planet, Nevada. WEX has a tight share structure, and Agnico Eagle is a 16% shareholder. So I just want to point out these 3 companies, Teck, Barrick, and Agnico. So they all have majors taking big stakes in these companies, offering validation for the quality of the projects, the quality of the teams. And I'm happy to introduce Darcy Marud, CEO of Western Exploration. Thank you very much for your time and attention today.